consumers of America. And I want to welcome everybody to the event. I want to say that I can't think of a presentation that is more timely than this, given the winter that we've had and rising prices both in natural gas and in electricity. And in fact, the way we talk about it here at IECA, we think that manufacturers have moved from an era of relatively low natural gas and low electricity prices and high reliability over the last 3 years into a new era of escalating prices and declining reliability. And that's dangerous. That's costly for manufacturers. The webinar today with Natural Gas Intelligence, who is a new member of our supplier council. I want to welcome them. But the data they provide is strategic and really important to manufacturing and making good decisions in these times of difficulty. So I want to say thank you to NGI, and I'm looking forward to your presentation. Thank you. Bye.
Thank you, Paul. And thank you to the IECA for coming today. From what I hear, we've got great numbers for today. So thank you all for taking the time out of your day to listen to our presentation. We hope you find it informative and useful for your business. For those of you who are unfamiliar with NGI, we are a price data provider, natural gas price data, news and analysis. And so some of the news and analysis and fundamentals that you'll be hearing us talk about today, you can find those in our flagship publication. It's natural gas intelligence daily gas price index. And then some of the price data that you'll be hearing our references are offered in some of these services that you see here. And so if you're not a subscriber already, not to worry, we've got a couple of QR codes that we've got throughout our presentation that you can click on to learn more about these services. And so with that, I'll get started with our agenda. For today's agenda, I will be starting off. My name is Leticia Gonzalez, and I'm the Managing Director of North American Natural Gas Pricing for NGI. And so I'm going to start off by kind of taking us on a history tour, recapping the winter and really taking a look back over the past year. So going back to even 2024, because that's really when the fundamentals started to change and set the stage for where we were in the winter time and where we are today. So taking a look at some of those production trends, the storage trends that materialized over the last year. Obviously, we are still in the winter season, but we'll be looking at, how this winter has fared compared to previous years and where, that demand that we've seen this winter has hit both the demand side and prices. My colleague Jameson Coughlin, who is the managing editor of LNG, he will be looking at a deep dive on some of the demand sectors. He'll be looking at LNG. So as you've heard, or as you've already seen, we've seen exports jump hugely over the past several years, with more to come. So he'll be taking us on a dive of those projects that are coming online here in North America in the very near term and medium term, as well as some of the projects that are expected to come online here in the next several years globally. And of course, as Paul mentioned, this presentation is very timely. President Trump is now underway in his second term in office, and already has signed a slew of executive orders, with a lot of those concentrated in the energy sector. So we want to there's been a lot of news day to day, but so we want to kind of just keep it very simple. And so what does this mean for the natural gas market? What does this mean for prices? And ultimately, what does this mean for you guys as customers? And so this will segue nicely into my colleague Dan Spangler's portion of the presentation. He'll be looking at the forward curves, and not just the Henry Hub forward curve. That's, of course, the benchmark for the US market, but there's also some other important key locations that are important to take a look at as these exports come come online, but also other sources of demand like data centers. And so with that, we'll take a look at price trends. So this chart here, I did go back to January 2024, and in the dark blue line, you'll see the Henry Hub prices, and then very faded nicely in the background, you'll see some other key locations. We've got the Chicago City Gate and SoCal City Gate, huge important markets for natural gas, and also markets where NGI is the index of record. So it's our prices that are tied into these pipeline tariffs. Waha as well, and Algonquin City Gate. If you're not familiar with Algonquin City Gate, that is kind of what we term as the benchmark for the New England region. So you've probably heard of it because prices are typically quite volatile there. But just taking a look at the past year, we kind of see some similarities in the January 2024 and January 2025. Obviously, we're in the dead of winter during those times. So back in 2024, we saw Henry Hub spike to about $13. This January, notably, we were only at about $10. This winter has definitely been colder than last. But as you can see, after last winter, we had that mid-January cold snap, but that was about it. There were some forecasts for cold last February that just didn't materialize. And then once we got out of, once the writing was kind of on the wall, the forecast was looking very mild. We also didn't withdraw from storage as much as people thought that we would. And so when we entered into the spring refill season last year, we actually had already about 2.2 TCF in the ground. And so this was 422 BCF above 2023 levels and over 600 BCF more than the prior year. I'm sorry, than the 5-year average. So again, huge surplus in underground storage to historical levels. And with very, very mild temperatures, producers quickly decided that they were going to curtail production. We saw some announcements taking place before the winter season even wrapped up. And if you're unfamiliar with the natural gas market, the official winter season does run from November to March. And so even before March was finished, we saw some curtailment announcements taking place. And so that continued. We did see volumes come out of the market and really stay out of the market because we never really saw prices get to a sustained high level. We did see some volume start to come back as we got into the core summer months. So when it was really hot, like July, August. But these were very small incremental volumes, not a huge significant growth by any stretch of the imagination. And you can see that flat line with here, let me turn on my pointer here. You can just kind of see here how very low prices were, even in the dead of summer, not a whole lot of movement there. You do see negative pricing in Waha, which we'll get to a little bit later, but it really wasn't until we started seeing the first signs of cold weather that we saw higher prices materialize at the Henry Hub. And then, so where are we today? Well, taking a look today at Henry Hub, cash prices yesterday were at about $4.50, but we saw lower prices in Chicago at about $3.85, and Waha, which again, I don't want to spill everything. We'll get into a little bit more later on in the presentation, but it was sitting at an average of only about 40 something cents, I believe. Same thing with Algonquin City Gate, typically a very volatile and high-priced market, but even that location was sitting at around $4 on Monday, so below Henry Hub. And so before we move on, if you haven't already, you'll see a QR code. I mentioned those at the start of the presentation, but if you haven't already, I encourage you to click on that to request a trial for our daily natural gas price data. So let's look at production trends because that's one of the main factors that a lot of people had been looking for to 2025. I did mention that some of the volumes did start returning last summer, but really it wasn't until this winter that we saw volumes really start to rise significantly. And there were several times over the past winter where production did reach over 107 BCF per day. Now, this was pretty much in line with where it hit last year, I think in January, but again, with the forecast calling for generally a mild February and March, it didn't stay at those levels very long. And even this morning, we saw production down to about 102, 103 BCF per day, which is down from 105 yesterday, but a lot of that is actually tied to maintenance. So that's going to be happening here increasingly so as we get into the spring season with a lot of these pipelines undergoing their seasonal turnarounds and whatnot. But really the big expectations and what people are looking for the rest of 2025 is just how much growth are we expected to see. And we're just getting out of the earnings season right now. And from what we're hearing from producers, they're staying in maintenance mode. They are certainly returning the volumes that they had curtailed back in 2024. But as far as like a huge increase in supply, that's not quite expected to materialize this year. That's going to be more of a 2026 and beyond plan. But there are lots of factors to consider and lots of variables that can change day to day on that front. For the EIA, for its part, however, they are projecting production to average about 1.5 BCF higher year over year in 2025 at about 104.6 BCF per day. And then, as you can see on this chart here, with a step up as we get into 2026. But I did mention that there's starting to be some supply concerns in the market, which I'll get to here on the next slide, I believe. But again, lots of variables for us to keep our eye on. And so we could see some of these risks to the upside for production for this year. Now, where will this production growth come from? I think everybody here is familiar enough with the Permian Basin. This is where we've actually seen the most growth take place over the last several years. Just in the last 3 years alone, we've seen dry gas production increase from around 13 BCF per day to more than 18 BCF per day. And that's just dry gas production. Associated gas production is near finished 2024 near record levels at around 20 BCF per day. So lots of gas coming out of the Permian. Alongside the natural gas growth that we've seen, we've also seen a lot of pipelines come online in that region as well. These aren't always perfectly aligned timing wise. Typically, you'll see the production overwhelming the existing takeaway and then really crushing prices in the region. I mentioned Waha on the previous chart, and here you can see just how much time over the last few years Waha in this dark blue line, you'll see just how much it has sunk below $1. Sunk below $0. So trading in the negative. And it definitely traded in the negative for a lot of 2024. And then, of course, Matterhorn Express pipeline. This was a 2 BCF pipeline that came out of the Permian, started up in the fall. And everybody thought, okay, great. Now we have a new pipeline capacity that's come into the market. This should be the end of negative pricing in the Permian. I said, it was way too soon to tell. Of course, we knew that the volumes coming out of that basin were going to quickly fill up Matterhorn. And then as we get into the winter season, negative prices isn't really something that we see because there's obviously strong demand everywhere. The real test for whether Waha goes negative again is the spring and fall. And I can say that looking at prices yesterday, Waha prices averaged only 26 cents. So I was actually giving it too much credit. It only averaged 26 cents. And we actually saw some trades as low as a dime. So we're still in the winter season, technically. The weather is beautiful here in Texas where I am. We've got a lot of weeks of nice, mild weather along with maintenance. So I mentioned that El Paso maintenance that's going on right now. That's exactly what tends to happen, is that you've got more pipeline capacity coming out of the market, but all of this production. So it just crushes those prices. And that's what we're seeing taking place right now, with, like I said, several weeks to go in the maintenance season. Now, that said, the Permian is still expected to grow. This is where all of the growth is expected to continue coming from. We've got many more pipelines that are in the queue right now. There is a small, I believe it's a half BCF per day extension coming off of Matterhorn Express called Blackfin. That one is expected to kind of further debottleneck the Katy area near Houston. We've also got, it's called the Hugh Brinson Pipeline. It was previously called Warrior Pipeline. This was a pipeline that should be moving gas from the Permian to the Dallas area. And so that one is expected to be completed in 2026 with about 1.5 BCF per day of throughput capacity, with expansions up to 2.2 BCF possible on that line. Oh, I guess before I move on, I should mention, now there are some risks. We've heard, like I said, the news is coming day to day. And OPEC recently did decide to bring back some supply in the market. So this has been kind of one of the bearish risks that we've seen for Permian, because a lot of the growth that we see from the Permian is associated gas. So the producers there aren't necessarily going after the natural gas, they're going after the oil. Well, if OPEC is bringing back supply, does that mean that Permian production won't grow as much? Analyst views are mixed, but it seems that the Permian is well in the money, even at a significant step lower below than where the $70 mark or so that prices are currently trading around. So even if we maybe get down to like in the $60 range, low $60 range, Permian production is expected to continue growing, and especially as we have those pipelines with firm transport coming into the market, we are still expecting to see growth out of that basin. Now, turning to storage, this is one of the huge drivers of even day-to-day price movements. If you're familiar at all with the EIA's inventory report that comes out every Thursday, that report more than any can significantly move the market one way or the other. And so looking at stocks, at the end of February, we fell to 1.76 TCF. And so we still have another 4 weeks of reporting in the winter season, with withdrawals expected for at least most of those weeks. And it's important to note that 1.76 is the lowest level that we've had since 2022. And if you remember 2022, that the low storage levels, along with a slew of other factors, including notably some global events, is what sent us on the track to much higher prices temporarily in the natural gas market. But there's also a lot of other factors that could materialize and that we're watching for. Renewables is a huge one. Just taking a look at the weekly storage inventory report, a lot of times in the South Central region, for example, a lot of the pipelines in Texas for are intrastate, meaning that they don't have to, post publicly available, data. So it's really hard to gauge, what's flowing on those pipelines. And so a lot of times when there's a big miss in what analysts are projecting the next storage withdrawal to be, and it comes in much higher or much lower, a lot of times that has to do with wind. It has to do with wind generation in Texas, where there's a huge there's a lot of wind energy. And so as we get into the winter season, even last week, that's actually kind of one of the things I've been complaining about here in Houston, is that the temperature itself hasn't been all that bad, but when you get that wind coming in, it makes a huge difference. And so that's where we can maybe see stronger wind lead to bigger storage injections. So that's something that we're going to be keeping an eye on. Obviously, we've also seen a lot of solar additions in the market. And so if we have more solar capacity that's running as well, then that could also influence natural gas inventories in the sense that there will be more natural gas available to replenish the stocks that we've lost over the winter season. Now, of course, that we've also got, the summer forecast and cooling demand, LNG, hurricanes. We could literally probably do a webinar on just each of those, but I won't go into too much detail on those. But lots of variables that we're watching and why that Thursday report is so crucial for the market. Looking at demand trends now, overall demand is trending higher year over year. It trended higher in 2024, up 1.6 BCF per day year over year. And looking at the first 3 months of the year, well, just not even 3 full months, but just March to date, through 2.5 months, we're significantly higher year over year, upwards of 10 BCF per day. Now we're in the winter season, so that's not completely unexpected. We would need to take the whole year um, to really make those apples to apples comparison. But what I want to note is that we've been hearing year over year that power burns are expected to decline. We've been hearing that for a couple of years. But as we sit today, we're up 2.17 year over year. So that's something that we'll be keeping an eye on. We have been, like I said, surprising to the upside. But will 2025 be the year that they finally do decline? Like I mentioned, we've got more solar capacity coming into the market. We've still got the wind, and we've got the higher prices as well. And so will that change, the consumption habits of natural gas? So that's something that we'll be keeping an eye on. I'm not going to get too much into LNG and data centers here on this part because we've got definitely more to come on that. Now, looking at this very, very early summer forecast, and I picked June, July, and August from NOAA's forecast. Still way very early, so that a lot of this is modeled. But generally speaking, very early indications are pointing to another, at least average to above average summer forecast. Now, this isn't a surprise because that's how it's been the last couple of years. But one thing I want to note on the slide on the left is where the heat is expected to take place. And we're looking here at, all of these above normal temperatures likely taking place in Texas, but also throughout the Southwest and up into the Northwest. And so that's important to note too, because that also is something that transpired in 2022 and led to much higher prices in California and throughout, the desert Southwest and even into the Pacific Northwest. So that's something that we're keeping an eye on. Okay, getting into electric power consumption now. As I mentioned, this is the sector that has kept surprising to the upside. But there's definitely a lot going on in the background of this particular sector. Number one, we've got 8.1 gigawatts of coal retirements that are expected to take place this year, which is double what we retired last year. Coal acts as sort of a buffer for, when it comes to reliability and, making sure that, the lights stay on. And so typically what happens is that when natural gas prices get a little bit too high, then you've got coal that can come in and people can switch to using their coal-fired facilities to generate their electricity. Well, if we don't have as much coal to generate, if we don't have as much of that capacity, then that takes out some of the wiggle room that we currently have in the market. And so that's something that we'll definitely be watching because we have a little bit less flexibility than we have in the past. Um, now on the flip side of that, we've got a lot of solar that has now come into the market. And so could that snag some of the market share that traditionally has fallen to natural gas? In 2024, the US saw a record breaking 50 gigawatts of solar additions installed. This was the single largest growth of any energy technology in the last 20 years. So very significant, and definitely stands to take some market share from natural gas. And then of course, combined with wind, we could see less demand coming from natural gas, which again would help the storage situation, which in turn would help prices. So this is a huge sector that we're keeping a close eye on as well. This is the one that everyone loves to talk about, and that's AI and data center demand. Um, you cannot go through a day with probably not seeing 20 headlines as it relates to data centers and all of demand that's coming for natural gas because of it. And that demand is actually already here. But I don't want to overhype anything. Honestly, the jury is still out. We know that it's coming. We know that demand for AI and data centers is going to increase. You can see here, this is from Rystad Energy, where the demand is coming from. And I can say that we do have natural gas generation in the queue of we only had 6 gigawatts in the queue in 2023. Well, now today that's 17 and a half. Not all of this will get built, but natural gas definitely has its advantages for being reliable, being available 24/7. These facilities that that need to run, they have to run 24/7. And we don't have we just don't have the solar capacity, the wind capacity, or even the battery capacity to truly be the sole energy provider for these facilities. So while all of the data centers won't get built, all of the natural gas facilities won't get built. There's still, there is demand that's coming for AI and data centers. We just don't know exactly how much. And just to put that into perspective, Kinder Morgan, for example, one of the major midstream companies in North America, they're projecting a 3 BCF per day of growth in power generation demand by 2030. Whereas when McKinsey, which is a consultancy for the market, they're actually projecting a 3 BCF decline. So that just kind of shows you, that nobody still really knows. We're still in the very early stages of this emerging demand source. And so, the projections are all over the place. It's coming. We just don't know how much. I will say, too, one of my colleagues recently wrote a very insightful piece that will be published here in a couple of days, about AI and data center demand. And one of the things he noted in his piece is gas turbines. There was hardly a market for those a few years ago. Now there's such strong demand that the wait times are in the years. The average may be around 4 years, but he's seen even some up to 8 years waiting for gas turbines. So that means that maybe we don't need to necessarily be looking at 2030 as, how much growth is going to happen between now and then, but maybe some of that growth really won't start to materialize until we get into the early 2030s, just because, again, citing those delays in the turbines themselves. Of course, we all know LNG demand is rising. We are at record levels. This is our North American LNG flow tracker. I'm not going to steal too much of Jameson's thunder, but just to note here, this is the kind of data that we have available, and you can see the flows over the last couple of weeks and how they've trended. This is remarkable considering in 2016, this number was zero, at least in part of the year. Or yes, 2015, 2016 timeframe when Cheniere Energy brought on their Sabine Pass facility. So that said, we've gone from zero to almost 16 BCF per day, and it really hasn't been, there have been some fluctuations in the market, like I mentioned, 2022, where we saw higher gas prices for several months, but the market did correct itself. And we saw historically low prices for almost all of last year and low prices the prior year too. So we might be seeing some higher prices right now. And I'm not going to steal Dan's thunder either, but we'll take a look at the forward prices and how all of this rising LNG demand may be impacting North American natural gas prices. Alongside LNG demand, we've also got exports going to Mexico. Mexico doesn't have a lot of its own production, and in fact, Pemex, which is the state-owned oil producer or oil and gas producer there, their production was actually down 9% year over year. So the little bit they have is actually already falling. Upstream growth there as well has declined, or at least did so in 2024. So imports from the United States are critical there. Of course, the tariffs are playing, those are a major wild card, but Mexico needs our natural gas. And during the summer, we are exporting sometimes on some days upwards of 7 or 8 BCF per day. Generally speaking, it's anywhere from 5 to 8, with the higher end being in the summer months. But it's not insignificant, and these numbers are growing. So this is one we'll be definitely keeping our eye on Mexico as the tariffs and everything unfold, and we get some more clarity there. But they're definitely pose a huge downside risk to the Mexican economy and power demand. Very quickly, I just wanted to, because we talked about Mexico, I wanted to quickly talk about Canada. We've got some LNG demand rising there as well, but we also have cross-border flows with Canada, and this is just a snapshot over the last several, I guess it goes back to the beginning of March. This is our Canada border tracker, so you can see there how much gas is flowing in from Canada and even how much that we are exporting to Canada, and see how some of those relationships work. And this, I want to note here, March 4th and 5th, these are the days that the tariffs were imposed. And so analyst views are mixed. I will say that this isn't, I think that drop was probably due to the tariffs, but they have recovered some. And so this is also typical, we are getting closer to the end of the winter season. So it's not atypical to see flows decline coming across the border, but to drop so significantly on the very day that the tariffs, were implemented, I think that kind of is the writing on the wall there. So that's just something that we're obviously going to be keeping an eye on. Same thing with Mexico, and see how that relationship and our flows change. And with that, that wraps up my portion. So I want to turn it over now to Jameson Coughlin, our managing editor of LNG.
All right, great. Thank you, Letty. Appreciate it. Hello, everyone. As Letty said, I'm Jameson Coughlin, managing editor of LNG here at Natural Gas Intelligence. I oversee our coverage of the global natural gas market. I'm going to discuss the profound impacts that LNG exports have had on the U.S. gas market, and I'll try to give a basic overview of the road ahead and how exports will evolve. So let's get into it here. So as many of you know, U.S. LNG capacity has expanded rapidly over the last 9 years. The country is now the largest LNG exporter in the world. As Letty hinted at, the speed of LNG development has really been astonishing and revolutionary in a lot of ways for the natural gas industry and its growth, both at home and abroad. And it's really been an inflection point similar to the shale gas revolution that added all this gas supply earlier this century and helped fuel the rapid export growth we're seeing now. And so to give an idea of how quickly the sector has developed here, the first LNG export facility in the U.S. actually opened in Alaska in 1969. And for more than 40 years, it was the only facility of its kind in the United States. LNG exports started from the lower 48 states back in 2016 from the Sabine Pass terminal in Louisiana, which was originally designed to import LNG. And you can see in this graphic here, which is actually pretty popular in LNG circles these days, just how far we've come in a matter of years and where we're headed. I think Letty noted this in her presentation, but essentially we've went from exporting no LNG to exporting about 16 billion cubic feet a day in under a decade. That's a lot of natural gas, and it's going to continue growing. And just for context, 1 billion cubic feet a day of natural gas can power more than 20,000 homes. So if we take a closer look, you can see there are currently 7 existing liquefaction terminals and another 5 that are under construction. Plaquemine and Corpus Christi Stage 3 started producing LNG late last year. Those are the latest additions, and they're ramping up, but they're still technically under construction. But they're both scheduled to come online next year. So by 2026, peak U.S. LNG production capacity should be right around 18.7 billion cubic feet a day. And by the time the other 3 terminals that are under construction enter service, there'll be 12 U.S. export facilities operating with a peak capacity of a little more than 25 billion cubic feet a day, according to our calculations. And that figure, it also includes these 2 smaller facilities down in Mexico. You can see in this chart that will also utilize U.S. feed gas to produce LNG. So to put this into perspective, LNG exports account for about 12% of current U.S. gas demand right now. We estimate that LNG exports will grow to 20% of U.S. gas demand by the end of the decade. And it's been estimated that U.S. natural gas production will need to rise from about 100 billion cubic feet a day currently to 120 billion cubic feet a day to help meet all of this LNG demand. So before I move on from supply and demand fundamentals, I want to take a quick look at the international gas market to show how the big picture impacts end users in the United States. It's a slow ramp up, but there's about 120 million tons of LNG, or roughly 16 billion cubic feet a day, that's expected to come online across the world between now and 2030. The bulk of that is, of course, located in the United States, and that's a lot of LNG. And it would technically be bigger than the previous 2 LNG supply cycles dating back to 2009, as you can see here in this graphic. But a lot of this supply is going to come online after 2026. These are big projects, right? They have to work through delays and other challenges. So the point is that all this new LNG will come to the market in kind of a staggered way. So last year, global LNG supply increased by 2.5% from 2023, or below the average annual growth rate of 8% between 2016 and 2020. Growth is set to pick up in 2025 to 5% as more new facilities come online, but that's still slower than it has been in recent years. And then other sources of natural gas supply overseas beyond LNG, things like domestic production in other countries, are actually expected to grow slowly too. So the global market is going to be tight for the next couple of years, and LNG prices are expected to remain fairly high as Europe and Asia compete for those limited supplies. So the point is, in the nearer term, U.S. LNG demand is going to be very strong. For example, Europe has had a very cold winter. They've lost even more Russian gas supplies, and they're going to need to replenish their natural gas storage inventories pretty aggressively this summer. The U.S. is Europe's top LNG supplier, so it's poised to ship more LNG to the continent as a result. Demand is a little more muted in Asia, but if you get heat waves or stronger industrial demand in parts of the region, that could create more competition for LNG cargoes this summer, and that's going to keep the market competitive this year. So What that means is US LNG remains attractive to overseas buyers, and it's also very profitable to produce and export from the States. And you can see the gulf between prices in Asia, Europe, and the United States here in this chart, which shows you can earn really a lot more for US gas overseas. That light blue line there at the bottom is NGI's daily Henry Hub spot price. That's a pretty good proxy for the Henry Hub futures that are linked to LNG sales. You can see how much cheaper US gas is compared to the prices that are being earned right now in Europe and Asia. So as we've heard today, the price of US gas is right around $4 right now. It's currently around $13 in Asia and Europe. So demand will remain strong in the coming years before, more LNG supply hits the market, prices come down, and the market balances more. And even then, LNG demand is expected to remain pretty strong through the next decade or so. So what have all these exports done to U.S. natural gas prices and those that burn gas here at home? Well, there's two ways to look at this, and it's a bit complex, I guess you could say. First, the data suggests that prices haven't really been all that impacted by LNG exports, and they're not likely to be impacted in the future. Both the Department of Energy and the Energy Information Administration have determined that LNG exports are influencing prices, but not by much, which still, has an impact for some, as I'll get to here shortly. But both agencies have found that even in a high LNG build-out scenario, U.S. gas prices are likely to rise to levels just below $5 over the next 20 years or so. And as I said, they're right around $4 right now. So one study by the Department of Energy that was released back in December found that amounted to an increase of about 3 cents per MMBTU for every 1 billion cubic feet a day added above current and sanctioned LNG capacity. That's not a huge increase at all. And if you look at NGI's forward curve data at Henry Hub over the next 10 years, which is the graphic you see here in front of you, prices are still right around $4. So our data shows that things are actually pretty stable as well. Prices are going to move probably a little bit higher in the next couple of years as more LNG demand comes online. But, if domestic gas production keeps pace, which is expected at this point, they will likely level out. Now, the other way to think about this is volatility. And that's the measure of how much daily gas prices change each day. And this is where LNG has had a far more noticeable impact. U.S. gas price volatility has increased in recent years, and you can see that here in this graphic with all these kind of peaks and troughs. And so the most important part of this graphic is that dashed line there towards the bottom that is sloping higher. And that shows how volatility has kind of trended upward over the last 4 years. So why is this? Well, as LNG exports have grown exponentially and natural gas accounts for a larger share of U.S. power generation, domestic gas prices have grown increasingly volatile. And that's because, baseload natural gas demand, or the minimum that has to be met on a daily basis across the country, has increased. So there's really less wiggle room to respond to extreme weather events or pipeline outages if you have more firm transportation needs or more demand that needs to be met each day. And the big spikes here on this graphic that are near like 700% volatility, those mostly came during extreme weather, for example. And some of NGI's natural gas prices have hit well over $100 in recent years, during cold snaps, particularly up in the Northeast, where there is less pipeline capacity that's available. I would also say, too, that the market is also very attuned to LNG exports as they grow, which itself can cause these brief price spikes or sharp declines. And we saw that back in 2022 when Freeport LNG actually exploded in the middle of a big international price rally. And the loss of demand at the time just really crushed U.S. prices. And, volatility can be very costly depending on whether you've got your supply secured or not. So just a quick high-level overview of what this all means for end users. And these are things that I've kind of just drawn anecdotally from NGI's reporting. But sectoral sensitivities to natural gas volatility are creating more interest in expanding infrastructure in areas of high growth like the Gulf Coast. And this is mainly expanding existing pipelines, right? It's very difficult because of environmental opposition to build new pipelines. Like I said, particularly up in the Northeast, where they've seen a lot of resistance. So AI data centers, LNG export facilities, utilities, power generators, they're all driving this interest. But some others that have not really had to worry about staying ahead of supply concerns are getting more involved in conversations to better marry supply and demand. So, for example, we've heard that some industrial end users, which typically have interruptible supply, are having more conversations about securing firm transportation as the market gets more volatile. And I think it's worth noting too that, U.S. natural gas consumption has hit new highs in recent years, and that's largely been driven by the power sector, weather, and low prices. And of course, LNG is adding to that demand too. So moving forward, there are a few other LNG related things to consider as President Trump's second term gets into full swing. Look, the president campaigned on a promise for energy dominance, and he has promised to, unleash American energy globally. This factors pretty heavily into his economic agenda, I think. Of course, President Biden had paused approving new LNG projects to study whether more exports were in the public interest, and that pause impacted and slowed down about 7 commercially advanced LNG projects that are close to moving forward. And Trump actually issued an executive order to lift that pause and resume project approvals, which could expand exports in the future. And in fact, the Trump administration has already approved one of those commercially advanced projects, and that is Commonwealth LNG in Louisiana. Another thing he's done is he has declared a national energy emergency, which we know does not exist, but this could allow for infrastructure to get permitted faster. And alternatively, I would say too, in what could be a setback for LNG, Trump will impose steel tariffs tomorrow that could raise prices or delay export projects that rely on those materials. But on the whole, Trump's presidency is viewed as a positive for the oil and gas industry. And at the end of the day, a lot of these LNG projects that haven't moved ahead yet will ultimately have to work through typical market challenges. They've got to sign up customers for their LNG. They've got to get financing. These projects that haven't went ahead yet, they're not a sure thing. And as I mentioned, Commonwealth LNG did receive federal approval, but the project hasn't been sanctioned yet, and it won't move forward until they finalize some of those things. So beyond what is currently under construction, it's really kind of hard to say what other LNG projects might advance as, the market is competitive and other export facilities overseas are being developed too. Okay, that does it for me. I will now turn it over to Dan Spangler, NGI's Director of Analytics. Dan?
Thank you, Jameson, and thank you, Lay, for that look back on where we've been in the natural gas industry over the past year. I really want to focus on where we're going, and to do that, we'll look at our forward curves that NGI puts out. Before jumping into prices, I want to back up a little bit and look at industrial demand in the U.S. So this chart here is from the EIA. Data only goes up till 2003. But I really wanted to focus on this more to look at general trends rather than focusing on what's happening right now. And so obviously U.S. gas use has jumped up for industrial use since the shale revolution in 2008, 2009, which led to lower gas prices, more gas available. You can see on that top line is the total U.S. gas use, and then I've highlighted the top 9 states in that stacked area chart below. Those 9 states make up about 65% of the total industrial gas use in the US. So it really is concentrated in a handful of areas. The outliers there are very clearly Texas on top there. And then that dark blue line a little bit further down is Louisiana. which are both growing since the early 2000s. Contrast that with California down at the bottom there in orange, makes up a significant portion of the industrial gas use in the U.S., but has not been growing. So the reason I bring this up is it's important to look at the prices of natural gas, not just at Henry Hub, but also at these regional hubs to really see what's going on in each one of these states. So to first look at Henry Hub, this goes into a little bit more detail for the forward curve that Jameson had up earlier. And really what I want to highlight here is what natural gas futures were trading at in 2024 versus what they were trading at just last Thursday in 2025. So that light blue line is where we saw the curve a year ago, and dark blue is where it was at on Thursday. You can notice a pretty big difference, especially close in the curve here from 2025 up through about end of 2026. Really widened, prices got a lot more expensive. And even just over the weekend and on Friday, prices jumped up by about another 20 cents or so, going down that same portion of the curve. So what are the real fundamental drivers for why that jumped up so much over the past year? And primarily it's weather. So weather is still king in natural gas markets for driving short-term demand and setting prices. The 2024-2025 winter was significantly colder than what was originally expected. So that drove higher demand, drove up prices. We pulled a lot more from storage than was expected. And as Letty highlighted on a chart earlier, we're well below the 5-year average for where natural gas storage levels are generally for this time of year. So it'll be a challenge for the market to react to that and fill storage to levels that really gets the market comfortable by the time we get to winter, which is why you still see those high prices up at like $5.50 or now at like $5.60 something cents for the winter of 26. Before that curve sort of collapses and goes back closer to what we were thinking in 2024. And that's just the delay for the market to react to those prices, higher prices incentivizing production, and then production keeping up with demand. And you can even see later in the curve, the 2025 numbers are below what we were saying in 2024. And that is likely just another piece of that delayed effect of higher prices now leading to more production and production catching up with demand. More importantly, so this really just shows the volatility in futures markets. A lot of that is due to weather normalized demand growth, so structural demand growth. Those will be the LNG exports or the natural gas for power for data centers that Jameson and Letty mentioned. But the increasing demand, increasing supply, all raise volatility primarily because the storage in the US, which is really used as a buffer, not just for the winter and summer seasons, but for that daily balances, is staying static. And has actually dropped in some areas, most notably the Aliso Canyon storage field in Southern California, which sprung a leak and was shut down a few years ago. So without that buffer, and with that buffer relatively less compared to the total supply and demand, that's just going to increase volatility. There's going to be less room for the market to make up those swings. I mentioned that Henry Hub is the benchmark for the US natural gas, but it's important to look at other regional hubs because prices can be so different. So this map here highlights the locations where NGI tracks forward curves for all of these 74 different regional hubs. They are sized based on their very rough liquidity. So looking at the volume that we've seen traded so far in 2025, and then also the open interest of those contracts going out the curve. So you can see demand areas like down in Texas, the blue dot, and Waha and the Permian. Up in Canada, Nova ACO, another big demand area, and then the Eastern Gas South, formerly Dominion South, in the Marcellus Utica over by Pennsylvania and Ohio. Those are major major producing areas, supply areas. Whereas the demand areas like that orange dot around Chicago City Gate, and the 4 dots that you see around California, Those are all indexes of record for NGI, and so they're good to look at NGI data for that, because the prices of these futures contracts will ultimately need to settle on the data that NGI is putting out in our bid week and daily products. And so it's good to tie those together to really see what's happening in the future, and where we're going, and how that lines up with bid week and daily data. So what does this all mean for industrial users? I've highlighted a few of those curves in areas where we saw states with high demand. So the curve on the bottom there in yellow, that's Waha, again, that producing region that we've talked about going into negative prices due to constraints for getting gas out of that region. You can see that alleviating some as we get further down the curve. That's certainly not because we're projecting production to drop in Waha. That's more just those pipeline projects that Letty mentioned, really easing those constraints. But you can see there in mid 2026, the futures prices are still getting pretty close to zero. So it's still very much constrained in the near term. And that's contrasted with a hub like Algonquin City Gate, which Letty mentioned is around the Boston region. There's not a ton of industrial demand up in that area, but I wanted to highlight it just because of how dramatic the prices are there, especially compared to other areas in the US, and how dramatic those seasonal swings are. Last thing to mention, I want to highlight California, the SoCal City Gate prices there in light blue, primarily because they have a very different profile for the forward curve. So you can see the typical winter spikes that we see, where as demand rises in the winter, we see prices go up to meet it. But there's also that pretty significant jump there in summer, especially late summer. And that's driven by gas for power demand in California. And as we see more coal retirements, more gas-fired generators come online, that becomes a bigger piece across the US and not just in California. So to highlight another point of that, this is again California. This is our PG&E City Gate, which is more central California. This is again similar to that the Henry Hub chart, where we're looking at what the forward prices were looking like in 2024 versus just last week in 2025. Again, you can see they're very different. There's been a lot of changes over the past year, but they didn't change in line with Henry Hub. California is a very constrained market, and if you're trying to look at what gas prices are going to do in California, and you're only looking at the benchmark of Henry Hub, you're not going to get the complete picture, and in a lot of cases, they move completely opposite one another. So you can see that here in winter 26, where at Henry Hub, we saw prices really shoot up between the past year for what's expected in winter 26. In California here, you actually saw that drop down a little bit. And actually throughout the curve here, we're seeing California drop down. Again, it all goes back to supply, demand, and storage. California is moving away from natural gas. They need to import everything. They have like very constrained areas, especially in times of high demand, getting gas in. So we see those high prices. We see crazy volatility, those wild spikes out in California where prices just go wild. But as they shift away more and the demand drops down, then that starts to lessen a little bit, and we see prices start to come under a little bit more control further down the curve. So that's it for my piece on our forward curves. Again, if you want to trial any of the data here, scan that QR code. That includes our forward curve or our forward look product, which includes forward curves, news and analysis, and our recently announced add-on product, which is forward curves that released at the end of the trading day. And with that, I'll turn it back over to Letty to cover some of the key takeaways of the presentation. Over to you, Letty.
All right, thank you, Dan. I'll just leave this slide up and I won't run through the key takeaways, but we're down to a minute, and I'm not sure that we actually have time. I don't know if we are like technologically allowed to go over our time slot. But real quick, Jameson, if I can sneak in one question for you that I saw come through the chat. And just as an FYI, if you do have questions, please do drop them into the chat, because we're more than happy to circle back with you after the webinar in the coming days to answer those questions for you. But Jameson, this one is for you, and it's hugely important for our audience today, is really how smart is it to be exporting all of this American natural gas overseas?
Yeah, great. Well, that's that's a logical question, because there are like 24 other LNG projects that have been proposed beyond what's already under construction and in operation. And as I already noted, those numbers are already high, right? There's a lot of facilities that are being built, and there's a lot of facilities that are in operation. Some of the plants too that are being built have actually already announced some big expansions as well. So there is a lot of gas that's potentially poised to go overseas. And, this was also the logic behind the Biden administration's pause on approving, new projects. Is this really in the public interest? But, the government does periodically review that. However, Trump is very clearly a proponent of fossil fuels. He favors them over other energy sources. And I think that that's very clear. I would also say too that there are geopolitical advantages to exporting more LNG, and Trump is also very clearly leveraging that right now. But if you step, outside of the political arena and you think about this from a market perspective, or a developer's perspective, I would say that the more gas that you flood the market with helps to bring prices down, right? It creates additional demand, and it makes gas more competitive in the long run versus other energy sources. And, the LNG market is very cyclical like that, and developers are really aware of this. In the longer term, as far as the U.S. is concerned, it really depends on how domestic production keeps pace. I think that part of that will govern, how much gas can actually go overseas. I mean, there are concerns about production from tier one gas plays, these really prolific gas fields dwindling, if LNG exports continue growing aggressively like they are, right now. And if that happens, producers would have to move into tier two plays in places like the Rockies and elsewhere that are, farther from the Gulf Coast. So, I think that's something to think about. But, just to kind of cap this here, I would say that, at the end of the day, the market is going to govern how much LNG is actually developed for export. And a lot of these projects might not really even move ahead.
Right. Well, and I'm glad you got into the production side of it, because I saw another question coming in the queue that I was going to tackle. But you're right in mentioning the tier two areas and getting into that, which would obviously be more expensive. Now, that said, there are so many fundamentals that are, so many variables that can change the game. I mean, look at COVID. So, obviously you, Dan, and myself will be keeping an eye on things and how things materialize. We're in still the very, very early days of Trump's second presidency. There's still a lot to hash out when it comes to the tariffs and LNG demand, data centers, all of it. And so we thank you all for listening. And as I said, if you do have a question, please do drop it into the chat box, and we will follow up with you following the presentation. Again, also, please click on any of the QR codes that you feel may benefit you and your company. And with that, I'd like to thank you all for joining us today, and take care.